Welcome all. GMT Academy launched free financial analyst program that covers the various aspects which is required to become a investment banker or financial analyst with top-notch companies like JP Morgan, Goldman Sachs, BNY, Northern Trust, fund houses like Citco, Apex, Line Data, and many more. So, throughout this series, we wanted to encourage you guys to understand the various aspects of investment spectrum and also to help you guys how you can grow in your career, because investment banking and fund accounting both are growing sectors at the moment. And as per analysis or study whatever that we have done, so it seems like at least for 2023, by 2023, or maybe sorry, 2030, so you might see huge growth in this sector. And that's what, with regards to that pretext, we have decided to run the recorded sessions, or this batch, continuous batch, where you guys can understand about, as I said, various investment strategies, products, then different participants, rules, regulations, audits, or a number of tasks that we're going to brief you throughout this program. But before that, we want a commitment from you. At least see, to design content or to design PPTs or to design everything, it's not an easy job. I'm paying around 10 to 15,000 to to the editor. And if you guys can at least subscribe to this channel and share this content with others, that will help me to generate some revenue which I can pay the salaries to the my that editors and all, right? Because if you guys just watch it and leave it and without putting any comment and all, so that doesn't make any sense. If you like, do it. If you don't like, that's fine. If you don't want to like, that's fine, but at least share with others. So in that way you can also that contribute your efforts to grow this GMT Academy. All right. So without taking much time, this tutorial or this free course, or I would say full investment banking course, will help you to understand different aspect and all. So let's start. Okay. So if I talk about, let's say, let's start it. So started it means I'll start and I'll go from the basics so that you can understand it. Right. If I talk about investment and banking, both are different aspect, right? Banking, it means we know it, where we have a different departments. For example, retail banking, commercial banking, then mortgage banking, right? Insurance banking. Banking, it means fund. So this is related with the fund. Sorry, fund. So where banks can manage the fund, or maybe banks can offer loans, or maybe banks can offer different facilities. It can be advisory, it can be asset management, security, safety, custodian. So there are a number of activities that comes under the bank, right? And one of the activity here you would see, that is investment banking. Investment banking. Why investment banking is important, or why we're going to discuss about investment bank? As I said, there are a number of things. Even we'll discuss about custodian banking as well. See, those are the now profitable sectors, and I want to discuss only profitable sectors where you can find a good opportunities. And that's what, so here we're going to discuss all about investment banking and all. And that will help you to understand what are the different investment banks, what services that they offer, and how you're going to do when you join as an investment banker with the top-notch banks like DB, JP, Goldman Sachs, and many more, right? So we have means custodian banking segment as well, commercial banking, lending. There are many more, but the investment banking is one of the highly paying domain. And after that, so you might see portfolio management services, or That is also comes under private wealth management. But again, it's a part of investment banking that comes under the investment banking, where investment banks offer portfolio management services to the fund businesses as well as to the individual or institutional clients, right? So where they charge the high transaction fees to the portfolio managers, fund managers, asset management companies, and many more. And that's what investment banking is, one of the highly growing department vertical, or you can say many. See, that depends on you how you want to look at it. But yes, so here you would see a number of activities that comes under the investment banking. But my point is banking, which is something different. Banking, it means they offer financial services to the client. It can be deposit, it can be withdrawal, it can be safe keep services, it can be transfer, or many more. The same way here. So if you add investment function, that becomes investment banking, where same bankers will offer advice on investment. Same bankers will advise on investment opportunities, how investor can invest into different variety of financial instruments. So that's how here you can relate investment and banking. So it means investment which are different. So here you would see different types of investment strategies, or maybe different types of financial instruments. And when we say banking segment, so we have a different banking segments. As I said, retail banking, commercial banking, mortgage banking, investment banking. And when we say bank, it means they offer financial services. Financial services, it can be deposit, withdrawal, transfer, anything. The similar way, if you add investment word, investment, it means investment into the different financial instruments. As I said, equity, bonds, debentures, and many more. If you start to invest into it, that becomes your investment banking. And here we are going to discuss about investment banking and all. So with regards to that, we have scheduled this session, right? And I'm sure you will enjoy this. And I hope now you got the idea about what is investment banking. If the banks provide services, it can be, let's say, portfolio, as I said, portfolio management service. It can be advisory service, trade support, buy and sell, and there are many more other activities as well. If you see all those activities, even merger and acquisition research, that all activities comes under the investment banking vertical or domain. So I'll take you ahead to see what we have different in our plate to discuss. There are different types of investment, as you know. So land is the one where most of the, if I take the example of even private equity, right? So private equity funds, hedge funds, right? All they invest into real estate as well. But apart from that, if you see mortgage loan and all, what is that exactly? Mortgage, it means to offer funding to the maybe lands or under construction projects, or maybe projects where, let's say, builder XYZ builder, if they're looking for a funding, right? So they can raise funding on that particular asset, so that becomes real estate funding and all. But yes, so real estate, land, or under construction projects is one of the big spectrum where the investment banks, they invest their funding into such financial instruments or assets. So land is the one, the segment or instruments that you can say. Commodities like oil, seeds, cotton, jute, sugar, uh, then beans. There are many more, right? There are many more. And see, after all, commodity, land, those are the necessities. And here you would see frequent, the trading activities you would see under the segments land and commodities. Oil, so that the popular one. So right, you would have seen, like, in pandemic, suddenly that oil prices drops, right? And now in US or UK, that you would see the oil prices suddenly spiked. Why? Because of Ukraine and Russia war or border escalation. So if you can relate with such events, but try to understand it. So when we say commodities, it means commodities. It can be your cotton, jute, sugar. It can be anything. So where we place the trades or funds or maybe investment banks, they support us or they provide functionalities or technical and tactical support where participants like buyer and seller of such commodities and all, maybe digitally or physically, so where investment banks support or help them to get the deals executed. But yes, commodity is one of the big segment where most of the participants, they invest or buy and sell. Then apart from that, the third one you would see securities. It means debt or maybe equity. When we say debt, it means it can be fixed income securities or it can be equities, preference equities, bonds, debentures. Or apart from that, nowadays we have one more segment. If I can add, like derivatives, like options, futures, swaps, and there are many more where the fund managers or investment banks or different participants, they invest into it, right? Apart from the debt securities, equity or bonds. And then the cash segment where we call it as a fake assets. See, it's a definition that where we call it as a fake assets to the cash, right? It's just a definition, but it's not a fake assets. It's an approach where some people will or experts will call it as a fake asset. Some people will call it as a real asset. So that depends. Because here equity, bonds, commodities, debentures, we call it as a real assets. But eventually, if you want to buy real assets, then you need a cash, right? Then how can you say cash is a fake asset? So you might see that arguments around it. But yes, so as per the few experts, or there are two different classes of people where they believe like this the cash is a fake assets, right? So yeah, so there are the major segments, five segments: land, commodities, securities, cash, and derivatives, where the investments, where investment banks, they support to buy and sell into those assets. Okay. So what about investment strategies? Then now we have seen the investment products like equity, bonds, debentures. But now here, if you see investment strategies, what are the investment strategies and how we invest? Various investment strategies allow all types of investors the opportunity to maximize return on their investment according to their individual needs. If I take the example of, let's say, student, can student take a huge risk? I'm sure no. If I take the example of, let's say, person who is at a 25 to 30 age and earning 50 lakhs per month or maybe per year. So of course this guy can take a huge risk, right? If I take the example of, let's say, the person who is at let's say 60 or 70 age, right? If you're at a 70 age and you don't have any income resources and all, and you're fully depends on, let's assume it, only one income resource or maybe your pension schemes or pension fund, whatever that you have received, then will you be able to take the risk at the age of 70? I'm sure no. So it means every individual has a different financial needs and their different financial risk appetite. Accordingly, that the investment banks can help you guys to design the investment strategies, right? So they can design, for example, if I take the example of mutual fund is for a middle class people. If I take the example of hedge fund is for a risky people who has ample amount of money and who are willing to take a risk. They can invest in hedge funds. And if I take the example of private equity, again, which is for wealthy people who are ready to take a risk and as well as who are ready to invest with a big amount, right? So that's how your investment strategies define on the basis of investment and as well as on the basis of your individual needs. If you don't have a money, then you can invest in mutual fund. If you have a money, you can invest in hedge fund. And if you have a let's say money and as well as a risk appetite, then you can go ahead with private equity as well. So see this. So this you can relate with the strategies. Strategies always comes with individual needs, right? and where the investment banks, they incorporate the needs of each individuals and they design pools, and that pools you can call it as a mutual funds, hedge funds, and private equities. Correct? Then, before developing an investment strategy, investor must consider the objectives and constraint influencing their investment choices. So, first is your individual needs, second is investment choices, and objectives are what the investor wishes to accomplish by the investing, means by investing what you want to achieve. Sometime you would say investor will comes with the, let's say they are looking for a handsome amount at the age of 70, maybe let's say let's say for example you have your planning in place where you want to fund to utilize for your kids education, right? Maybe you want to buy a car, four-wheeler, house. It can be anything. Anything, it means anything. Your individual needs can be anything. Your investment choices, it can be anything, right? So that's how they can means design the investment strategies and provide you the concurrent solution for your needs. All right. And examples, if I take, objectives can be to generate a steady and secure income flow, to maintain liquidity, or to have a specified amount of money available at a particular time in the future, to increase the initial capital by a substantial amount, etc. Not all objectives are mutually exclusive, but different objectives require different types of investments and strategies. Constant provides the framework of limitations within which the stated objectives will be perceived, and constant can be liquidity requirements, tax considerations, legal and regulatory requirements, or circumstances of the investors. So if you see all of this, we have already discussed about it. So if you have a, let's say, investment means, that depends on your investment goal or choice, preferences, and what you want from the investment. On the basis of that, investment banks help you to design the investment strategies, right? And this comes under investment strategies and all comes under portfolio management services as well as advisory services, where investment banks, they perform work as an advisory. So they'll advise you how you can design or build or create your investment portfolio. So I hope now you got the idea how how the investment banks plays crucial role in advising part as well, right? And if you are looking for an advising job, then you should have a qualification like CFA, CFRM, CA, so that you can, and at least you should have experience as well how investment pools works or investment works, and accordingly you can work or you can join such a businesses and processes. Okay. Then risk return trade off. The risk return trade off is a subjective principle of investment strategy. Before a strategy can be developed, the amount of risk an investor is willing to take must be considered. Generally, the highest risk investment will offer the highest potential returns as well as the highest potential for losses as well. So if we see how the risk, this risk and reward works, risk and reward works like this. If you see risk and reward, if you see higher risk, higher reward, right? And higher reward, it means eventually higher risk. For example, let's say penny stocks, you would see huge risk. Let's say 1 rupees price, so that can be 100 rupees price within the next 1 month, but sometime this one becomes zero as well. That also happened. So it means that is what you can call it as a risk. If I take the example of, let's say, sound or mid cap companies, or maybe large cap companies like TCS, risk could be low, but in terms of return, you cannot expect huge return. But if I take the example of, let's say, as I said, small cap companies or penny stocks who has no sound background or fundamentals are weak, in that case, if you invest, So your investment might would be at risk, but what if that company converts everything into positive ways? So that company can also offer sound returns. And here, if you see risk and reward return, it means always that works in the opposite direction: high risk, high return, and high return, high risk, right? Or low risk, low return. In that way, uh, you can relate, and moderate risk, moderate return. So define the investor's risk, define the investor's risk appetite and rewards expectation. On the basis of that, you can design the investment strategies. And then what about diversification? Diversification is also one of the big factor where you can diversify the investment. For example, let's say you have 100 rupees, right? So it depends on you how you want to invest, correct? So you can invest in equity because equity is a risky one, as I said. So you can invest, let's say, 30 rupees in equity. Fixed income, where they offer coupon payments and all, fixed income. So you can invest 40 rupees in fixed income. And let's say remaining 30, that maybe you can carry as a cash if you want. That depends on you what how you want to do it. And that's what you can say, like it's a allocation of assets, or maybe diversification of the your fund or investment. And if you diversify in this way, so you can protect your investment, you can generate the regular return, and as well as you can also manage. See, managing of cash or investment, which is not easy, and it's not even that what I would say, the job where you can quickly perform it. No, this process will take time to protect, even in investment in a volatile space, or a place where you would see huge risk. It's not a easy job, and that's what diversification come into picture. So where you can diversify your assets. Diversification, it means reduce an investor's exposure to risk by spreading a variety of investment choices among different asset categories. Diversification works on the theory of not putting all of your eggs in one basket. You would have heard, which is a famous quote, and most of the investors, they follow the same, correct? So they don't put all eggs in one basket. All right. By choosing investment in a different markets or industries, or mixing equity and debt, the investor is protected from a negative impact in one category for a diversification to be effective. And the chosen investment should not fluctuate in a similar fashion, such that external market conditions would cause the investor investments to rise or fall in value at the same time. Diversification implies that if one asset or investment category performs poorly, the entire portfolio will not be affected. So, in that way, you can manage your investment in a different financial instrument. So, we'll quickly see the rule, what rule that you can follow while ensuring that the effective diversification strategies and all. So here, that same same task, you can call it as a dynamic assets allocation as well. So every investment, or in everyone invest for the same basic reason, to make their assets work as hard as they can, and then to meet a set of financial objectives. But those objectives are different for each of us, and they define how we invest. All right. The relationship between your needs, resources, goals, and tolerance for risk will pinpoint the asset allocation strategy, the method by which you divide your assets among stocks, bonds, cash, and the best for you. The different strategies are based on several factors and differ in how they balance risk and reward. In general, higher growth means greater emphasis on the stocks, and higher level of risk, it means and even higher level of risk. And identifying your investment objectives will help you decide which investment strategy is right for you. As I said, it's a basic of risk reward that works on the basis of investors risk appetite and income. That's it. All right. Then asset allocation, one formula that we'll discuss now, and rest will see in next part. Asset allocation is related to the diversification and refers to the question of what percentage of portfolio should be invested in any assets category in order to maximize return within the risk parameters desired, determining an optimal asset mix of any combination of investments, including short-term debts, stocks, bonds, real estate, options, futures, venture capital, and derivatives. Enhance the investor's ability to achieve desired return. You need a capital preservation strategy. So it means you can invest 10% in stocks, right? Like TCS, Wipro, and many more. Bonds, it means government bonds, or it can be private bonds, and cash, where you can say FX market, or maybe money market instruments where you can invest, or liquid, resources that you can invest. So this is how you can allocate the assets or diversify the assets for a risk mitigation, and as well as to mitigate your financial needs as well, because in an investment space, survival becomes most important. And if you, let's say, don't have a strategy to survive, then that doesn't make any sense to be a part of this or investment into it. Okay, so we'll continue with this and cover this entire series. Meanwhile, I'll take a pause here. If you can ask questions in comment if you have any, so I'll pick up it and then answer it out, maybe in my next session. Thank you.